This is about MACRS depreciation. It's just another method for depreciating things. Instead of depreciating them straight line, you can use there are different systems. This is just one alternative system. The MACRS, I think, stands for Modified Accelerated Cost Recovery System. I'm not 100% sure they have something like that. It's just the accelerated part means you depreciate more early on. And so that's what we're doing here. And so we're going to use this schedule to depreciate a machine that we spent $40,000 on. And the MACRS system is pretty straightforward. It gives you a percentage for each year. Notice the 5-year schedule has 6 years to it, and that's just a quirk in the system. They have there's always an extra year. So the 5-year schedule has 6 years. The 10-year schedule will have 11 years. The 8-year schedule will have 9 years. There's just always an extra year. But in this case, we're using the 5-year schedule. We're going to depreciate $40,000 using these percentages. And what you do is just every year you multiply the original cost times the percentage of that year, and that will be your depreciation expense. So in the first year, the original cost of $40,000 times 20% will have depreciation of $8,000. In the second year, we'll multiply the original cost times 32% and have depreciation of that much. And so on and so forth. Right? If you go all 6 years, these percentages add up to 100%. So after 6 years, you will have depreciated the entire amount, the entire $40,000. Okay, so I've got an example here. So we bought this machine for $40,000. We're depreciating it using this 5-year schedule. We're going to sell it 3 years later for $22,000. Okay, and so if we sell it for 3 years at $22,000, we want to know what are the after-tax proceeds from the sale, because we're going to have to pay taxes on anything we sell it for above the book value. Okay, so we're going to have to figure out the book value. Well, to figure out the book value, we take the original cost, $40,000, then subtract all the depreciation that we've taken over that time period. So in this case, we just figured these on the previous page here using those percentages. So you can see those numbers repeated here again. I'm subtracting off the total amount of depreciation I've taken over 3 years. That gives me a book value of $11,520. So the taxable gain on the sale is the difference between the amount I sold it for and the book value. That's $10,480. I have to pay 35% of that in taxes, so that's that amount, $36.68. And so remember now, there's only 2 things here that are cash. I sold it for $22,000, and then I figured out the taxes paid, and I have to pay that in cash, $3,668. So the cash that I have left, the after-tax proceeds from the sale, is $22,000 minus the taxes paid. That's $18,332. Okay. I have another example here. So this is a machine that costs $52,000. And I'm using this same 5-year schedule. It says what's the book value in the 3rd year. So I've got this in Excel here just to show you how you would figure that out. The original cost is $52,000. Here's my MACRS schedule. So the amount of depreciation expense I would take each year is that percentage times 52,000. And I can just copy that down. So for those 3 years, that's how much I'm going to depreciate. I want to know the book value at the end of year 3, so I can take, well, how much depreciation did I use over those 3 years? I can add all of those amounts up. So the book value at the end of year 3 would be the original cost, the $52,000, minus the total depreciation, which would be $14,976. And so the taxes that I have to pay is going to be the tax rate, the 38%, times the difference between the sale price and the book value. I think I'm getting ahead of myself because I think that's on the next slide. So there's the book value at the end of year 3, $14,976. You can see how I figured that out. And then I think the problem says if you sell the machine for $21,000 at the end of year 3, so we can go back to the spreadsheet here. I can calculate the taxable amount. Well, that's going to be $21,000 that I sell it for minus the book value. So I have to pay taxes on $6,024. So then the taxes that I have to pay is going to be the 38% times that $6,024. So you can see the taxes paid is the $21,000, the amount I sell it for, minus the book value. I have to pay taxes on that, and then 38% of that amount is the taxes due, $2,289.12. That would be option A here. Okay, that will be the taxes on that one. Okay, so there's that example there. Okay, and here's one more. Okay, this is a straight line example. 3 years ago, a company bought a machine for $100,000. It's been depreciated on a straight line basis over a 10-year life, so obviously $10,000 per year. They're selling it now for $84,000. If the tax rate's 38%, what are the after-tax proceeds? Well, again, I just have to figure out what will the book value be. Well, if I'm selling it after 3 years, I've depreciated $30,000 of it, $10,000 a year for 3 years. So the book value will be $70,000. I'm going to sell it for $84,000, so I have to report a taxable gain of $14,000. So I'm going to have to pay 38% on that $14,000. That's $5,320. And now remember, the proceeds from the sale is going to be the cash I got from selling it, $84,000, minus the taxes paid. And that turns out to be $78,680. Okay, and then here's the same example using the MACRS schedule. Here is the 10-year schedule, and actually there is another year here, 11. I just didn't include it on there because it didn't fit on the slide. And it's not important here because we're selling it after 3 years. Let's see. After 3 years, yes. So we really only need these percentages here. And so what I have here is the depreciation amounts. Since it's on $100,000, it's pretty easy to calculate these depreciation amounts, right? Just that percentage times 100,000 gives me those depreciation amounts. The book value after 3 years is the original cost of $100,000 minus the total depreciation I've taken over 3 years. That ends up being $57,600. Okay. I've got an alternative method there. Yeah, I could just add up the percentages and multiply that times the original amount. That's doing the same thing. Okay, give me the book value after 3 years. I'm going to sell it for $84,000, so I have to subtract off the book value. That gives me a gain of $26,400. Pay taxes on that. And then the after-tax proceeds is the cash I get from selling it, $84,000, minus the taxes I have to pay. And that leaves me with $73,968. Okay, so there's some examples there. You also have a problem on the capital budgeting part 2, problem set 1 handout that you'll have the answer to. So you can practice that.